Let's get a technical check on these stocks as well as markets. And even Nitin Raheja is joining us from Julius Baer to talk to us about the fundamentals of the market. But since we're on the discussion of chemical and fertilizer sector, Kunal, let me first get a sense from you on the chart. A lot of these stocks, right from FACT to RCF to Balaji Amines, Tata Chemicals, GSFC, the list is really long. Anything that is catching your attention?
Yeah, I think many of the fertilizer stocks, RCF for example, has managed to come back towards a breakout of the previous high. I think it's a 52-week as well as a multi-year high for RCF. Looks very attractive at current levels of 150. GNFC also is another stock from a similar space which has been doing pretty well. GSFC, I think yesterday or day before, the stock had already broken past about the 215 to 20 mark, and today the stock has managed to build up higher from those levels. So that's an attractive space. From the chemical basket, I think the likes of SRF as well as Navin Fluorines are the ones which have been looking attractive. Many of the other stocks are trying to play a catch up for themselves, but I think the charts for SRF has been a bit more stronger as well as a leading one as compared to the other peers.
Okay. Nitin, the amine space, be it alkyl amines or Balaji amines, both are up in trade. Now what we understand from a chemical check is that methanol prices have come down by around 9% and they're one of the major consumers for the same. Hence, obviously, their raw material costs will come down. But how do you see this chemical space, the entire chemical basket? Because we are also hearing that soda ash prices are moving up, inventory issues are coming down. So what is your view when it comes to the chemical space currently?
Look, I think chemical as a story is something that needs to be played more from a long-term perspective rather than looking at it in a short term. Clearly, all the issues plaguing the chemical companies with respect to stocking up and so on and so forth are going to play themselves out over the next couple of quarters. Right? When our interaction, just as you sort of talked about, also gives us the impression that I think chemical companies will start seeing better days as we go 2 quarters down the road. Now, within those, I think it's very important to see that the other sort of headwind that we are also seeing currently in chemicals is that there is a slowdown in Europe. A lot of clients in Europe are holding back orders. So I think there is a short-term challenge that the space is seeing. But I think if you take a little longer-term view of at least the next 1.5, 2 years, clearly I think there are very interesting plays that reside in the sector. There is a stickiness to the business. Clients don't really change their suppliers very often. There is a whole process in terms of getting empaneled with these business clients. And so I think some of the existing companies have actually seen a reality check in terms of valuations. In fact, the last 2 years, if you see, chemicals have done virtually nothing. The high lofted multiples have progressively come down. And now I think some of them are trading at valuations which could be great contrarian plays to look at.
Contrarian plays and all of those factors that you pointed out, European slowdown and the pricing and all of that is something that we discussed with the management of Anupam Rasayan as well earlier in the day. In fact, listen into what they told us.
Destocking is an issue. Yes, the channels have had a little bit of more inventory than what the market was comfortable with, and the industry is unwinding that. That is pushing the demand for the backstream guys a little further to by a few quarters. Yes, China is coming in, and that also is reducing the kind of market supply, increasing the market supply and reducing the demand further for the industry. If you look at in total, I would say that probably by that large part of the whole pain has been through, and I guess in next quarter or two you should be able to see something moving back to a more normal growth that we have been seeing in the past as well. If we see the manufacturing in Europe has been a bit of a challenge, that's true, but see, at the end of the day, there is large capacities, especially for the formulators and for the brand owners and the market, and that we don't see that is going to go off significantly over the near term period. Probably there will be a lot more of offshoring happening, and that's probably the opportunity for countries like India and China, which will really be taking the advantage of the offshoring that would happen from a branded guys to which they were typically doing it in Europe to, let's say, Saltigos and Lanxesses and all. which will come to probably to companies like us and to our peers and the industry here.
Okay. Paytm is one stock that would remain in focus. The company has its conference call today with analysts, and now what we're understanding from ET Tech is that they have temporarily halted their postpaid operations as their NBFC partners are now a bit wary against, given the fact that RBI had raised the risk weightages by around 25% against unsecured lending. Nooresh, on technical indicators, how is Paytm chart looking like? The stock is down currently 2%. Nooresh?
Technically, yeah, technically, Paytm has gone through a long enough consolidation of the last 1.5, 2 years, and then gave a breakout about that 750 mark. Now, 750 was the breakout in June. It went up towards that 950,000 mark a few times over the last few months, but 750 remains a base. So it's a contrarian buy on dips closer to 750 to 800 mark. So in this dip, it should be a buy with a medium-term outlook. A lot of these names in the new age tech have gone through enough consolidation and slowly and steadily should do well. So this dip is a good time to actually start accumulating.
Time to buy some of the stocks like Paytm as well. But Nitin, what's your view on the oil marketing companies? Somit was just highlighting the City note that we have got the price upgrades that we have, and despite that massive run-up that we have seen on the likes of HPCL, etc., they're still suggesting an upside of 30%. Would you buy to that argument that there is value on the table for these public sector entities in the oil and gas space?
Look, I think these companies were intrinsically trading at such cheap valuations, and with reason, right? Of course, the fact of the matter is that they are highly regulated entities. Although oil pricing was freed up, but we've seen indirect intervention take place from time to time, especially during the elections and so on and so forth. So you need to play them more as short-term tactical plays as such, and clearly the valuations are yet not really dear. So I think there is some upside that clearly resides out there. However, it all needs to be seen because we're getting into elections in the next 6 months' time, and sometime in March the election code would come into play. Post which, I don't think the government can do a lot. But in that intervening phase, if oil prices were to run up, and the government wants to check inflation, you could once again have a soft intervention where not allowing them enough leeway. So these companies to us are more short-term tactical plays, and given the cheap valuations, to answer you, yes, possibly in the current scenario there is some upside there.
Some upside left. That's the net view coming in on the oil and energy space. But hold that thought, Nitin. It's time now to slip into a very short break. When we come back, we'll discuss whole host of other stocks as well with a panel of experts. Don't go anywhere. Welcome back. Well, a lot of stocks buzzing around in the trading session. In fact, the market too is inching higher towards the highest point of the trading session. It's Sirma SGS, which is higher. You have Union Bank of India, which is doing quite well. Bank of India has seen solid demand. QIP, so that stock too is in focus, and a lot of PSU banking names actually doing okay. What's on the back foot is clearly sugar. Take a look at Balrampur Chini, that's down about 3%. Triveni Engineering is coming under pressure, and a lot of other names from that space are also down. But Nitin, the space I want to discuss with you is power as well. Today, of course, there was this fresh note that came in from Jefferies, but today if you look at stocks like Tata Power, even the other power stocks, they're all rising in the trading session. JSW Energy is up 5%. What's your view on power as a sector? Is it still a long-term bet, gains to be made over the next 12-24 months?
So, I think there's one round of re-rating that has happened in power. As a sector perspective, it's a much more steady sector, right? You won't get outsized gains from it. The fact of the matter is that if you look at power, there has been huge underinvestment that happened over a decade. And now, as industrial growth has come back, we'll be focusing more on manufacturing as one of the areas of growth. Also, as more and more investment has gone into renewable, there is balancing power that is required from the traditional power sources. So clearly, you will see growth happening in all the power stocks in terms of investments coming back, whether in terms of efficiency, whether in terms of fresh investment. And more importantly, each of them will also have a value unlocking that will happen because they will all have a renewable energy play within them, within a subsidiary, and so on and so forth, which could attract, PE investment or get separately listed. So I think if you take a longer term outlook to power, I think clearly there is a story that is there for the next couple of years.
Well, Kunal, Bajaj Finance, how are you looking at the Bajaj Finance chart? Because if you see in the last 1 month, it has not contributed much to the index's rally. It's down around 2% odd. How is Bajaj Finance looking right now?
I think it's looking exceptional on the charts. Samit, I would probably believe that at 74.50 odd levels where it's trading right now, it could be a very good zone to try and buy the stock, expecting that the stock would get back into that line of outperformance. Now, there is one minor resistance for Bajaj Finance. I call it minor because even in the previous attempt, the stock took a pause for a couple of days before it managed to surpass the key moving average. I think that's closer to 74, 75 for the stock on the spot levels, which means another 40 points, 50 points from the current zone for Bajaj Finance. But I believe with the kind of volumes which you've seen in this leg of recovery, and especially at the bottom when the stock was almost at 7,000 mark, it's indicated that maybe the worst could be behind and the stock could probably get into a breakout. So we'll either wait out for a minor resistance breakout, which is 74, 75 odd mark for Bajaj Finance, and post that we could be looking at even an 8,000 plus kind of a target over the very short term.
Point taken, but I also wanted to shift the focus and in fact discuss the NBFC space further. What's your view, Nitin, on this? Is it the time that those private banking names which were underperformers of this year will catch up and NBFCs etc. will take the back seat in 2024?
So, there are two things that are going to happen. As the uncertainty around the election starts reducing, and we've already seen that in the last couple of days, FPIs which were selling into the Indian markets, and a large part of the selling was happening in the private banking space, which was an over-owned sector for them, will come down. And when private capital starts getting attracted, or FPI capital starts coming back to India, clearly the way the banking sector is positioned today, whether you look at growth, these are all 18-20% earnings growth compounders who are trading at 2 to anywhere between 2.5 times book. The largest private bank in the country is trading at a valuation I haven't seen in the last 25 years. So I think once you see FPI flows come back, you will see momentum come back into them. The domestic mutual funds who have actually been holding this and have sort of suffered an underperformance because this whole sector has really underperformed, will again start showing more interest and so on and so forth. So I think if you today, from a growth outlook, from a fundamental valuation outlook, if you look at it, I think that's one of the best places and most attractive places to be in.
Comes to the real estate space, now that is one sector that has been the top sectoral gainer on a year-to-date basis. It's up around 70 odd %. Do you see there's more value remaining on the table when it comes to the real estate sector?
If you look at traditional matrices, you will probably think that we're trading at top of cycle valuations. But what one needs to factor in is this, that the previous real estate cycle that we saw, the per capita GDP that where India traded at, vis-a-vis where we are trading today at, we are at $2,500 per capita, and it's expected to go to $4,800 over the next decade. You will probably see a lot more sustainability in this real estate rally. Having said that, it is very difficult to, for these companies to get exorbitant valuations for one simple fact that they're all driven by promoters. It's very difficult to look at off-balance sheet liabilities in these companies, and hence most of them would trade traditionally close to their NAVs. Now, if you look at where they trade, they're almost trading close to NAV. So I think the re-rating in the sector is done. What you will see henceforth in the sector is the growth that will take place in terms of fresh projects and fresh sales and so on and so forth. So, and I think from that perspective, if you ask me, I think we yet have, quite a bit of legs in the rally that will take place and growth of the sector. I think it's been 3 years after a 10-year downturn that we have seen this upturn take place. I think I continue to believe that there is enough growth that will happen in real estate in the near future.
Canfin Homes is the next stock that we should keep an eye out for, because on the speculation of an incidence of fraud, the stock was down in trade. The management actually came in and addressed to one of the broking firms, Elara Capital, saying that they have completely denied any of this incidents, but the stock continues to decline. Nooresh, how is the chart for Canfin Homes looking like?
So the stock gave a breakout over the last few sessions. It was in a very tight range. After that gap down, it made a range of 730 to roughly 790. So the breakout is done, and now structurally should first test that 900 mark, which is where it topped out in the near term. So an initial target price of 900, and if that crosses, we get into a new all-time high. So there could be further momentum. So trading stop loss now to be placed below, say, 790, 800 levels. So a buy at current levels as well as on dips.
Fair enough. So that's the take coming in on Canfin Homes. But Nitin, what's your view on the entire auto sector? A bit of sector churn is what is quite visible. Those underperformers are seeing quite a bit of flow into them. So will autos be one of those candidates where people will book profits out of? Today, of course, CLSA had a downgrade coming in on two-wheelers.
It's what we saw in autos was led by a couple of phenomena, right? So the two-wheeler space was lagging, but premium two-wheelers were doing well, right? So you saw the TVSs of the world and the Aishas of the world perform better than say the Bajaj and Hero of the world. Now we've seen some sort of initial indication that there is a rural revival happening, and hence you've seen the other two stocks starting to catch up out there, considering their model base. In passenger vehicles, companies who had a model refresh actually landed up doing well, right? So anybody who was in the SUV game and had a head start there did well. Somebody who had in the EV game did well. So it was a game of model refreshes. I think we've gone through that cycle of model refreshes out in the PV segment. While Mahindra and Tata Motors have yet a waiting list, Maruti was a little late on the game, and so on and so forth. But what we are getting to understand now is that the pipeline inventory in the dealer channel is building up. In fact, the other day we were reading about the fact that the industry association has actually asked banks not to provide too much funding to dealers as they fear a build out of pipeline. So you could see post this festival season some element of slowdown in terms of PVs take place in the short term. But I think the model refresh and the long-term growth story continues. As far as CVs is concerned, it's seen a beautiful couple of years of cycle, and you've seen a re-rating take place. If you believe, but the capex program is going to see a short-term slowdown as we get into the election phase. So you see some amount of slowdown again take place. So if you ask me, autos are probably seen a short-term peak, but over a longer period of time, I think they will come back as economic growth continues.
Okay, so that's the take on the auto sector. Nitin, on that note, we let you go. Appreciate you making time and speaking with us.